Let's be honest, the market feels a little wild right now, doesn't it? We've got AI stocks hitting unbelievable highs, debt piling up, and the whole thing feels more concentrated than ever. So today, we're going to dig into how the world's greatest investor, Warren Buffett, would approach this exact kind of chaotic environment.
Buffett always kicks things off with this simple but powerful idea from baseball. See, in investing, the market is going to throw all sorts of pitches at you. Some fast, some slow, some just plain weird. But unlike in baseball, you don't have to swing. There's no penalty for just standing there and waiting for that perfect pitch right down the middle. This one idea, it's pretty much the core of his entire philosophy.
And why should we listen to him? Well, this number is a pretty good reason. Since 1965, Berkshire Hathaway has returned 5.5 million%. To put that in perspective, the S&P 500 returned about 39,000% over the same time. Yeah, so when he talks, it really pays to listen.
Okay, so how do we take that wisdom and use it right now as we're looking ahead? Well, we're going to walk through 4 big warning signs that Buffett sees in the market today. And then, and this is the important part, we'll cover the 4 timeless rules he uses to keep a level head when it feels like everyone else is losing theirs.
All right, warning sign number 1 is all about debt, specifically the crazy amount of money people are borrowing just to buy stocks. You know, this kind of leverage, it creates a really fragile foundation for the market, and it can artificially pump up prices way beyond what they're actually worth.
And this chart really tells the story. The amount of money being borrowed to buy stocks, what's called margin debt, is actually growing faster than the market itself. What that means is that a bigger and bigger piece of the market's value isn't built on real company earnings, but on borrowed money. And that just injects a massive amount of risk and volatility into the whole system. And Buffett, he couldn't be clearer on this. He never, ever borrows money to invest. Why? Because, as he says, anything can happen. You can survive a market downturn, sure, but a downturn when you're loaded up on debt, that can wipe you out completely. Game over.
So if the market's being fueled by all this debt and speculation, what do you do? Well, Buffett's first rule is incredibly simple, but it changes everything. He says, stop thinking about stocks as little flashing ticker symbols and start thinking of them as what they are, pieces of an actual business.
He tells this fantastic story about your imaginary business partner, Mr. Market. Now, Mr. Market is a bit moody. Every single day, he shows up and offers to either buy your shares or sell you his, and his prices are all over the place based on how he feels. A speculator gets totally wrapped up in Mr. Market's mood swings. But a real investor, they just ignore him. They ask one simple question. Is the price he's offering me today a good deal for the real business behind it? Now for the second big warning sign, concentration. Think of the S&P 500 like a big group project. Right now, a handful of students are doing almost all of the work, and that creates a huge risk for everyone's grade. Just look at these numbers. A mere 10 companies now make up an entire third of the S&P 500's value. That's even more top-heavy than it was during the dot-com bubble. And here's why that matters. If even a couple of these giants trip up, they can pull the whole index down with them. It doesn't matter how great the other 490 companies are doing. When you see all that concentration, especially in buzzy sectors like AI, it's so tempting to just jump in because you don't want to miss out. But Buffett's second rule is basically designed to stop you from making that exact mistake.
He loves to use this analogy from the turn of the last century. Back then, everyone knew the automobile was going to change the world. It was obvious, but there were 2,000 car companies. Could you have picked the tiny handful that would actually survive and win? Probably not. The lesson is, just because a technology is going to be revolutionary, that doesn't automatically make it a good investment.
And that idea perfectly tees up his concept of the circle of competence. Look, you don't need to be an expert on everything. You don't have to understand AI or biotech or quantum computing. You just need to be brutally honest with yourself about what you do understand, and then have the discipline to stay within that circle. Knowing what you don't know is probably the most powerful weapon an investor has.
Okay, our third warning sign comes from a tool that Buffett himself created. He once called it the best single measure of where valuations stand at any given moment. You might have heard of it. It's called the Buffett indicator. Now, what this thing does is pretty simple. It just compares the total value of the entire stock market to the country's total economic output, or GDP. And right now, it is flashing bright red. The market is valued almost 70% higher than its long-term average. And historically, whenever it gets to that level, it hasn't stayed there for long without some kind of major pullback.
So if the whole market seems overpriced, how on earth are you supposed to invest? Well, this leads us to Buffett's third rule, which might just be his most important one of all. You must demand a margin of safety.
He explains this with a perfect little analogy. Imagine you're driving a big truck. You come to a bridge with a sign that says capacity 10,000 pounds. Now, if your truck weighs 9,800 pounds, are you going to drive over it? No way. You drive a much lighter truck to leave yourself plenty of room for error. In investing, the company's real value is the bridge's capacity. The price you pay is the truck's weight, and that big, safe gap in between, that's your margin of safety. And in a risky market, you want that gap to be huge.
And the last warning sign isn't about numbers. It's about people. It's about behavior. We're seeing a massive spike in regular, everyday investors engaging in super risky, short-term trading. And that kind of gambling fever, well, historically, it's often a pretty good sign that we're near a market top.
Buffett's cure for this kind of frantic activity, this fear of missing out, is his fourth and final rule. It's a mental model he calls the 20 punch card. Seriously, think about this. What if you were given a card with only 20 punch holes, and each one represented one investment decision for your entire life? Would you waste a punch on some hot stock tip you heard? Of course not. You would research relentlessly, you would wait patiently, and you'd only swing when you were absolutely certain. It's a mental trick that forces discipline and true long-term thinking.
Now, this whole idea that doing less is actually more is backed up by this amazing story. Apparently, the investment company Fidelity once did a study to figure out which of their clients had the absolute best returns. And the answer they found was just incredible. The top-performing group were the investors who had died, and right behind them, the people who had simply forgotten they even had an account. The lesson is just so powerful. Oftentimes, the most profitable thing you can do is absolutely nothing. Make a smart choice, and then just let it be. So as we wrap up, it all comes down to this one question you should ask yourself. When you look at your own approach, are you getting swept up in Mr. Market's daily drama trying to play a short-term game? Or are you acting like a true long-term partner, focused on one thing, buying pieces of wonderful businesses at fair prices? Because honestly, the answer to that question could make all the difference in the world.